there's concerns over the stability of the financial system. They're back in focus. Shares in Silicon Valley Bank, also known as SVB, nosedived yesterday, causing a ripple effect for global equity markets. Major financial institutions in the U.S., Europe, and Asia have been the worst hit, really. Shares in SVB were up in pre-market before being halted pending news. Now, SVB is a key source of funding for tech sector startups. It also holds a lot of treasury debt on its balance sheet. When the Fed raises rates, the value of those bonds fall. And yesterday, the bank said it was issuing shares to raise money and cover those losses. That set off alarm bells. The announcement came amid the collapse of crypto-focused lender Silvergate, and a nervous market is now seemingly questioning balance sheets across the banking space. You can read all about it in the latest in today's morning brief, written by Miles Udland over at the Yahoo Finance homepage. Let's get back to a principal asset management chief global strategist, Seema Shah. So Seema, looking at all this and what's happening with bank stocks this morning, what was happening yesterday with SVB, what do you make of this? I mean, are we looking at a failure in banking, in just regional banks, in banks that service startups? What do you make of what's happening?
So look, I don't want to exaggerate the situation. You know, it's very difficult to ever know how far the ripple effects are going to go. I think that what we can say is that, look, the banking sector is probably going to be a part of the economy which could be challenged. We have an inverted yield curve, which is always a difficult situation for banks. We have a growth environment which is likely to deteriorate as we go through the year. So there's going to be a lot more loan provision, bad loans starting to come through. So this is going to be a challenging time. And on top of that, in this specific situation, it sits in a difficult part of the market, kind of a troika of banking industry, technology, which we've already seen has been very challenged, and then a bit of the private space, which maybe hasn't seen any of the catch up that we are seeing from public markets. The other part of this is that, look, when you have interest rates rising as quickly as they have, remember, this is the most aggressive Fed hiking cycle since the early 80s. When you have rates rising this quickly, inevitably some things will break. We have to expect that. It's very difficult to anticipate where it's going to break, but some of this is to be anticipated. And from here on, it's only going to be a question of just seeing how far the ripple effects go. But I want to say, look, there are banks, and of course, there's always going to be some banks in the US which are weaker. But broadly, the US banking industry is fairly well capitalized. So we're not looking at a major financial system collapse by any means at all. So it is going to be looking at day by day, but we know that there are difficulties coming ahead. But again, this is not going to be anything like the great financial crisis.
And Seema, I'm glad you're sort of making the distinction here. And just for our viewers to sort of explain here, this particular bank, which seemed to hold treasuries, mortgage-backed securities, according to reports on its balance sheet, a big bank probably holds that stuff too. The difference is a big bank doesn't necessarily need to sell those before maturity in order to raise cash, which appears to be what happened in this case, right, Seema? So, I guess, is there any way of sort of finding the other corners of the financial markets, of the financial system that are at risk before we see them, before we see another Silicon Valley bank or what have you?
Yeah, inevitably analysts are going to be looking out for which the banks which display similar characteristics. And as you rightly said, this is somewhat specific. This is not a factor which we should expect for the whole banking industry to be exhibiting by any means. But unfortunately, with markets, the way that they do work is there will be inevitably contagion. You can see that not just in the US banking sector, but even the European banking sector, which up till this point had actually performed extremely well. We have to just wait and see, but inevitably, yes, analysts are going to be looking out, seeing which other banks have the same characteristics, and those ones are going to be probably the more vulnerable out of all of them.
And I mean, as far as vulnerability, do you think that this could, if this bank is having such problems, are there going to be also other banks, but related to tech, related to the VC world? I mean, could this be sort of a major stress when it comes to the VC world and its portfolio companies, which are startups, which often are not profitable perhaps yet, which are burning a lot of cash?
So, as I said, it is difficult to ever know how far the ripple effects are going to be. There will be eyes on the industry inevitably. And many of them haven't had, of course, the same impact as we saw in public markets last year, which mainly means that they're due, or it could suggest that it's a sturdier part of the market. Sometimes the lack of liquidity is a good thing, because it means that you can just ride out the storm. As we know, for markets, it's time in the markets, not trying to time the market. So certainly for private markets, that is always a benefit. Unfortunately, at this point, I think it's very difficult to say. It's just something that we need to just watch out for. But I think that this is, if anything else, this is just alerting everyone that, look, when you have interest rates rising as quickly as they are today, there will be some areas of the market which will really start to struggle. And as we came into 2023, I think most analysts were aware of that and trying to figure out where that next pain point would be. And unfortunately, it does look like one of the areas is this one.
And Seema, finally on this topic, when you're talking to clients, is there any advice you're giving them in light of these events as they unfold in terms of how they should be looking at their portfolios?
In a way, so one of the things that we have been saying, so this is just a kind of a reiteration of the message that we've been giving for a couple of quarters now, which is that within your portfolios, we need to be looking at which are the sturdy businesses. It is not the time just to kind of go into one index and hope for the best. There will be nuances within each sector, which are going to be very, very important. This is the time to be looking for high quality assets. Look at where they have the sturdy, which ones are going to be able to withstand the increasingly difficult economic environment. We do think that you should have an increased number of treasuries, investment grade credit, things which essentially should perform well, or at least better, as the economy starts to struggle. So this is the time to really revisit your portfolios and make sure that you have got safety and defensive elements which are going to carry you through what could be a couple of stormy months.
Seems like a good idea right now. Seema, thank you so much for being here. Principal Asset Management Chief Global Strategist Seema Shah. Appreciate your time this morning. And there's one more tidbit, folks, that I just want to bring you on SVB. CNBC is reporting, according to David Faber there, who's citing sources familiar, that the company had tried to raise capital. In fact, that it also had tried to sell itself, and that the capital raise had not worked. And so now the company is potentially looking to sell itself. And according to CNBC, large financial institutions are looking at a potential purchase. And even as we speak, the shares of the company are still halted pending some kind of news. Of course, we will be monitoring it. We don't know what that news will be.